For decades, the best investments were locked behind $5 million minimums. Private equity deals that made billionaires richer. Hey, welcome back to lIHITRO Bank. My name is Adam. Real estate generating double-digit returns. Credit strategies beating the market. Regular people completely shut out. But something huge changed. Now you can access these same billionaire deals with just $10,000. Alternative investments just crossed the $1 trillion milestone. Alternative investments are anything that's not stocks or bonds. Private real estate, private credit, and private equity. These are what Yale and Harvard used to crush the stock market. Historical returns of 10 to 14% compared to 7 to 8% in public markets. Over 20 years, that's the difference between doubling your money and tripling it. Private equity used to require $5 million minimums and 10-year lockups. Only pension funds and endowments got access. But new structures changed everything. Non-traded REITs, interval funds, and NAV-based BDCs. These let you invest in the same deals with way lower minimums and better liquidity. The numbers are incredible. Alternative investments hit over $18 trillion at end of 2024, projected to reach $29 trillion by 2029. That's 60% growth in 5 years. Smart money is rotating from overvalued stocks into private alternatives with better returns. Alternative funds cross $1 trillion in fundraising in late 2025. The next trillion happens in just 5 years. When a category hits $1 trillion, it signals mainstream legitimacy. Regulatory frameworks exist. Track records are proven. Institutional quality is accessible to everyone. Wealthy investors allocate 20 to 30% of portfolios to alternatives for diversification. They spread across private real estate, credit, and equity. This protects them when stocks crash because private assets don't move with public markets. Blackstone's Real Estate Income Trust, Bright, is one of the largest private real estate funds for individuals. Over $50 billion in assets. Blackstone owns data centers, apartments, warehouses, hotels. Minimum investment? Just $2,500. Traditional funds required millions. Bright delivered over 10% annualized returns since 2017. That beats most publicly traded REITs. Private credit is massive. Banks pulled back from lending to mid-sized companies. Private credit funds stepped in, earning 8 to 12% annually. Blackstone's BCRED has $44 billion in assets and delivered over 10% returns since 2021. Minimum? $2,500. Established businesses paying premium rates. You don't need millions. Start with $10,000 minimum allocation. Look for non-traded REITs like Bright or interval funds in private credit. These offer quarterly liquidity, way better than 10-year lockups. Business development companies raised over $21 billion in 2024 for the third straight year. These provide loans to high-growth companies generating 7 to 10% annual returns. BDCs are open to non-accredited investors with $5,000 minimums. Interval funds are exploding. These offer quarterly redemptions of 5% of net asset value. In 2025, JP Morgan, Apollo, and Oaktree launched new products. Minimums range from $1,000 to $10,000. Perfect for private market exposure without giving up all liquidity. Timing matters now. Interest rates stabilized in late 2025 after Fed hiking ended. This created clarity for private managers. Deal activity surged 20% in early 2026. When there's clarity, private markets thrive. Getting in now positions you before the next appreciation wave. The institutional playbook works. Universities and pensions target 30% private real estate for stable income, 40% private credit for high yield, 30% private equity for growth. This beats public markets while reducing volatility. You can replicate this at smaller scale. Not all alternatives are equal. Sponsors matter. Blackstone, Apollo, KKR, and Brookfield have decades of track records. They have scale for best deals and expertise through cycles. Stick with established names. Fees matter. Alternatives charge 1 to 2% management fees annually. Some add performance fees. Understand total costs. Higher fees are acceptable if net returns still beat public markets, which top funds do. Liquidity is different. You can't sell instantly like stocks. Most offer quarterly windows with caps. Interval funds allow 5% redemptions quarterly. 10,000 invested means 500 redeemable per quarter. This illiquidity prevents panic selling and allows longer horizons for better returns. Democratization is real. In 2018, SEC allowed registered funds more private asset exposure. In 2025, SEC eliminated rules limiting offerings to accredited investors. Non-accredited investors with modest net worths now access institutional quality investments. Retail allocations to private capital will surge to $2.4 trillion by 2030, up from $80 billion recently. That's 30 times growth. Investors are demanding access, and industry is responding. What should you do? First, assess your situation. Alternatives should be 10 to 20% of portfolio, 30% for high net worth. Second, research platforms. Bright for real estate, BCR80 for credit, interval funds for diversified exposure. Third, understand fees and liquidity. Fourth, start small to gain experience. The wealthy diversified into alternatives, generating higher returns with less correlation to public markets. For decades, you couldn't because minimums were too high. That changed. The 1 trillion milestone proves these are mainstream. This is your chance to invest like institutions and wealthy families. 10,000 gets you into deals that required millions. Returns are proven. Structures are regulated. Timing is right as private markets heat up in 2026. If this opened your eyes, hit subscribe right now. I'm breaking down wealth strategies that work for real people. Subscribe and let's build wealth together. Thanks for watching.